presentation?
Yes.
All right, terrific. Thank you. Again, can apartment values really drop 40% or more? Let me go into presentation mode. There we go. My lawyer says I need to have a disclaimer every time I talk about multifamily. I am not an attorney. I'm not a CPA. I'm not a certified financial planner. I'm presenting this information as part of educational, informational, or entertainment purposes only. And if you get entertainment value out of this, please let me know. And if you think I can do something a little bit different other than dancing and music, then fine, I'll try to add it to it to make it more entertaining. But do not invest based solely on the contents of this presentation. Always consult your professional advisor. I've already gone through this. We're here to build relationships. We're here to invest in commercial multifamily, either individually or together, with the goal of creating massive cash flow and wealth for all of us, right? So the idea here is we're doing this because we like it, but we're also doing it because there's potential wealth on the other end, and we want to keep that goal in mind. And I do make a promise never to make you part of some guru's marketing funnel. So you're not going to hear me bring in some national guru trying to sell you a $1995 program or something like that. So just not going to do it. There are other groups that will, and if you want to see that, please join the other groups as well. But what you hear out there a lot is multifamily does great in a recession. So let's talk about some of the multifamily folklore out there and what may be driving that. One of the things they use to justify that multifamily is great in a recession and is the best investment is because millennials are going to rent forever. Millennials will stay in the urban core of large cities. Multifamily just always does well because people have to have a place to live. And cap rates, I'm hearing now, cap rates are going to stay low or go lower in the foreseeable future. So we're going to talk to each one of those major areas, including the millennials will rent forever. What we've started to see, and people don't know, it's not readily apparent yet, or hasn't been made overtly public unless you do the research, that millennials have started already moving out of the urban core, and they started doing so several years ago. Home ownership has increased amongst that group since 2018 by at least 2 or 3% of the overall amount. It used to be that home ownership in that group was about 59, 60, 61%. Now it's up to about 63, 64%. So we're seeing a migration as a lot of the millennials start to get older. They're starting to have families and stuff. They're realizing that living in the urban core, as attractive as it is, when you're a 20-something, when you're in your mid-30s or mid to late 30s, and you have family, that maybe you need a different lifestyle. On top of that is the cost of renting versus home ownership. And for those of you who live in the big metro areas or have lived in the big metro areas, and tonight I'll rely mostly on Philadelphia numbers, but the cost of renting in a Class A property, which is what the millennials like to be in, or a high-rise apartment building in the urban core, it's expensive. We're talking mid-2000s or higher per month in rent. When you look out in the suburbs, you can buy a house for that. And a lot of the millennials are starting to realize the potential value in ownership over renting, now that they've sort of considered that they're going to stay in an area. That's not true of all millennials or all young people, but we're starting to see a trend reversing to where they're making those cost-benefit relationships. We're seeing an increase in home ownership, and you'll see some numbers on that in a little bit. In fact, if you look at these 4 cities alone, the growth rates for those cities over the last number of years has been decreasing. Everyone wants to be in Dallas. Well, the growth rate in Dallas is approaching 0. San Francisco, well, as a matter of fact, in San Francisco right now, and we'll talk about a little more, but their vacancy rate now is 20%. And it's because a lot of people are saying, hey, my job's not secure, it's expensive to live here, or I just lost my job, or I've been furloughed, I can't afford to pay. And Raphael, you could tell us what the rental rates are in San Francisco, but as I understand it, they're totally ridiculous. And so people are moving out of San Francisco area.
Yeah, there was an article that came out just yesterday. The rents have dropped 33% in San Francisco
Yep.
in the
Well,
last
that's
2
even higher.
months.
Yep, that's amazing, isn't it?
Yeah, 33%. So a studio now is only $2,400.
And that's down 33%.
So
New
you
York
guys
City.
feel lucky.
Yep. New York City, you've heard the rumors, right? Manhattan is becoming a ghost town. People are leaving. Not that they're going far away, you know, because leaving New York City means going to Brooklyn or Staten Island, which to me is all part of the same, but apparently there's more space available there. And we're seeing vacancy rates of greater than 10% in Manhattan, and rents are dropping, and they're offering all kinds of concessions. And the same is true with Chicago. And that's just a snapshot of 4 of the largest cities. We're seeing this across the country, especially in the coastal, what they call the gateway towns. And then in, of course, Chicago being in the Midwest. So they're not staying in the urban core necessarily anymore. And that's something we have to keep in mind as we're looking at properties. And if they do stay in, like in the Philadelphia area, and this is Sunbelt, primary cities, and Snowbelt, and you can define Snowbelt as you want, but the one guy from Minnesota there, you understand Snowbelt probably better than anybody. And when I lived in upstate New York, same with me in Syracuse, 15 feet of snow a year. But we're seeing a move from the inner city or from the urban core to the suburbs in both regions. So more and more people are, if they're renting, they're still moving to the suburbs. And in fact, part of that is I read an article just last weekend that says, in fact, for those of us who know the Philadelphia area, Montgomery Township, which is where I happen to live, has the highest rental rate increase and the lowest vacancy rates, because a lot of people down in the city of Philly are moving out to this area here in King of Prussia to live, as opposed to being down in the city now. So the millennials are moving to the suburbs and they're buying homes. So we need to keep that in mind when we're looking at potentially buying properties. Multifamily does well in a recession. Well, we're going to talk a little bit in detail about this. Just a couple of data points first. During the Great Recession, and I'm just using Atlanta as an example here because it's hard to pull out a lot of different data, but Atlanta saw cap rates go from 4.5% up to 6.1% during 2008-2009 timeframe. So cap rates increased by over 1.5%, which, if you understand how cap rates apply to assessing the value of a property, that's a huge jump. And that's a big reduction in the value of properties. We just talked about vacancy in Manhattan and San Francisco. Freddie Mac forecasts that the average vacancy during this recession is going to rise to 7.2%. And that rent growth is going to decrease by 1.7%. And it's already down to 2.1% average rent growth. So basically rent growth is going to go to 0, and we're going to see average vacancy rise significantly to 7.2%, although nationally right now it's down around 5%.
So Dennis, it's going to drop 1.4. So, excuse me, 1.7. So rent growth will be at 0.4?
Yeah, roughly.
Wow. Okay. Thank you.
And that's on average. So that means some places are going to be a lot worse. You're going to see rent reductions. And then you're going to see some who are, some of the, depends on where in the market cycle different metro areas are, right? So. Oh, I see you're training your baby early. Good. In addition, right now in this current recession, 2.4% of all multifamily loans are in forbearance. That's $12.8 billion worth of loans right now.
Hey,
So,
Dennis.
Yeah.
I'm sorry to interrupt.
No, please.
But let's go back to that Freddie Mac forecast. So right now, if you're analyzing a deal, right?
Yep.
Would you put this this rent growth decrease into your analysis right now, or would you keep it, say, you know how like right now, some people may put 2.5 to roughly about 3% into rent growth year over year. So would you use that now?
I already have been. I have been
Okay.
since February.
Okay.
For
Well,
me
let's-
personally, when I underwrite year one at 0 rent growth. And then, slight increases after that. It depends on the market and how hot it is. If I'm in a really hot market right now, I might still use 2%. But
it also depends on the property that you're analyzing,
Yeah.
because if you're doing a value add, that is the rents are down 10% from what everybody else is charging, then you could still use your 2% rent growth. So you have to make sure you when you analyze them, you look at the specific situation. I mean, the guidelines that Dennis is talking about are really good, but you need to understand that your deal too. If you're in a hot market and everything is nothing, but there is no more growth of people or whatever because of the situation what's going on, then yeah, you might want to adjust it like to 0.5% or 0 growth for the first year. But if you're having a value add, which the markets with the rents are low already, and if and you have to rehab the property, then you can your rent growth still will be about, the 2% will be a safe bet, because you're not going to be increasing it 12%. You're just going to bring everything up to close to market because you're already down below.
Yeah,
So just be.
Yeah, exactly. But you just want to be careful on how you're evaluating, how you're getting into a property. And we'll talk about why more in here in just a couple of pages.
Okay, thanks.
Concessions are rising. We're starting to see property owners give concessions. And I give 2 examples here. Again, this weekend, I read an article where there's a new development company, a construction company that builds new Class A properties here in Philadelphia. They're having trouble filling their recently brought to market property, and they're offering in a range of 1 to 4 months of free rent already here in Philadelphia. So we're seeing rent concessions of between 1 and 4 months, at least in one aspect of a Class A property down in the city. And I suspect we're going to see more. For those of you who follow Grant Cardone, you've heard him say a number of times in some of his videos that he was offering 13 and 14-month rent terms for 12 months worth of rent. So in essence, he's giving 1 to 2 months of rent free in order to fill his Class A properties down in the Florida area. So it's not just happening here in Philadelphia, it's happening in Florida, and we're seeing it happen in New York City. We're seeing it happen in San Francisco. Those trends, they tend to be the early indicators, sort of the canary in the coal mine indicator. But we're going to see more if the recession continues, we'll see more of this. So if you're having to give concessions, even with what Raphael has to say, your assessments of how high your rents can be raised due to value add may have to take into account some of these concerns.
Well, over here recently, a Class A property that just came on the market a couple of months ago, and they filled up pretty quick. They went up for sale because the developer wants to get his money back and his profits. And they originally asked 38 million for the property. He's now down asking 28 million.
He's down $10 million, huh?
A $10 million down, reduction in price, because he's seeing that to get this place rented, he had to give a lot of concessions and stuff like that, and that the rents are not going up because all the other Class A properties around are renewing the rents at either at the same rate as before or lower.
Unfortunately, that's starting to be true in a lot of different places. And then on top of that, rent collections in this case are slowing. And you can see the thing here from the National Multifamily Housing Council that tracks rent collections across the country. Now, this is as an average. Usually when I talk to property owners, they say they haven't really had a lot of trouble collecting rents. But there's enough properties out there that at least in October, this is the lowest I've seen. I've been tracking this since February. This is the lowest I've seen to date. Halfway through the month, and the rent collections is still in the 80% range, as opposed to in the mid 90s where it has been in most of the previous months.
Yeah, Dennis, I just heard that same statistic from that organization a little earlier today on another webinar I was on, that they were like down to 87% through October 1 through mid-October.
Yep. And this is the right from their report. And this is the chart I just lifted straight from there.
Oh, yeah, you got it right there. Yeah, exactly.
So multifamily doing well in a recession, only if you're not going to have to give concessions and if you're not going to have trouble collecting rents and a bunch of other things. So here's vacancy versus recessions, going back to 1980. I just highlighted the last 3 recessions. Back here in 2000, it was the dot-com bubble and then the bust. And we saw vacancies go from just over 3%, almost all the way up, well, at the end, over 7% on the recovery from the recession. So vacancies went real high for multifamily after during this recessionary period, the dot-com recession. And then the Great Recession that a lot of us remember in the 08-09 timeframe, vacancies went from 5.5% up to 8%. So we saw, big jumps in vacancies during the last 2 recessionary periods. And I've got to move you guys here so that I can see here. When we look at the COVID recession, basically we're still in this sort of the beginning phases of it, but we've already started to see an uptick in vacancies from 2019. Right now it's still slight, but you can see that third arrow over here, it's going up now. We're up to 5% vacancy. And that number is projected to rise, as you saw earlier, from Freddie Mac up to over 7. So if you're owning multifamily properties now, hang on. And then we were talking concessions. This is an average percentage of concessions for Class A, Class B, and Class C properties. Here in 2020, we started to see concessions tick up from near the end of 2019, before the pandemic. We started to see an increase in concessions, especially through the second quarter of this year. We don't have data for the third quarter, but Class B properties, which most people say would be the most attractive, saw the largest increase of 0.5 percentage point. Class A properties are now at just under 5%, compared to 3.7% during the second quarter of 2019. So this is the percentage of concessions across the board, and there are all kinds of concessions property owners can provide. We've got someone making a lot of noise. Hello? Who's making noise here? If you could mute yourself, please, and until you're ready to ask a question, that'd be great. Thanks. So we're seeing concessions increase, and whether it's in lower deposits, whether it's in less rent or lower rent, or any number of other things that we're giving that have to be burned off.
Hey, Roman, can you mute yourself, Roman?
Trying to.
Oh, okay. I can't hear.
All right, great.
Thank you. Oops, let me go back. Part of what's been happening in the multifamily space is, they'll tell you that there's a shortage of workforce housing, and there's a reason for that, and it's called value add activity. When you normally look at the cap rates for different classes of property in different types of markets, you can see in this upper left-hand block here, you got your Class A, B, and C properties, and then your primary markets, your secondaries, and what we call the tertiaries, or out in the country markets. And typically you see cap rates, range about 1 percentage point, depending. Over the last number of years, it's been much tighter than this. But prior to the big recession in 2008 and 9, we would see cap rates about a point spread depending on within a class, depending on where in the market it was, and then between classes, right? So primary A class property would be a 5 cap. If you went to a B class property in the primary area, it'd be a 6 and then a 7 and on and on. So you can see this would be sort of a notional standard cap rate distribution for apartments. What we're seeing today, and this is the current average US cap rate distribution by market and class, is from 4.71 all the way out to 6.75. So it's been much tighter. And the reason for that tightness in cap rates is because people are taking older properties or B class properties and they're increasing value by improving on the properties. They're not letting as many properties fall into a condition that would allow them to be called workforce or working class or C class housing. So we're seeing a big tightness in people competing for B and C class properties to improve them and increase the rents and jump them up to B class properties, making them more expensive to buy. Just so keeping that in mind, as we see these cap rates compress, you know, all the cheap, what we would hope to be cheaper properties, the B and C class properties, are getting more expensive in compared to the class A properties. But in general, this tightness can only go so far. And when we go back and we look at this kind of thing, you're also going to see that the cap rates, you know, once they get that tight and then we start to see a recession, it's possible that the cap rates are going to start to expand again. In other words, the properties are going to lose value. And that's a part of the notion of what tonight's topic is all about, is that we're starting to see cap rates start to slow down in their compression. And with a lot of the pressure being brought to bear right now, because there's everyone out there looking for properties, we potentially could see at some point, if the market doesn't improve based on everything you saw today, that people and investors are just not going to invest, and you see those cap rates start to get larger again and values of properties go down, just like what you heard Raphael say about that one class A property down in Florida. And in fact, here's an example of cap rate, what we call a cap rate decompression or cap rate increases. During the 08-09 recession, cap rates at the start of the 08 area, you know, were around, on average, about 6%, between 6 and 6.25%, right here in this range. And then after 09, they jumped all the way up to, in some instances, over 7%, 7.5%. So cap rates can go up. And in this case, during the last recession, they went up by at least 1.5 points. So we want to be concerned and we want to be watching for that possible decompression in this market, depending on how this recession goes. And the idea is not to be afraid to buy, but it's to be aware of what some of the pitfalls are so that you can be planning ahead and have a good plan as to how you're going to buy this property and then what your operating plan for it is so that you can maintain its value or not lose a significant amount of value. Just quick, backup shot here. There's 21 million. They'll tell you there's only 10 million unemployed right now for a 7.9% unemployment rate, but they're not including the pandemic unemployment numbers, which are small businesses, gig workers, all those Uber drivers out there, some of the self-employed. So this is the total number of unemployed right now, based on this number of employees from the US Census. So we're really looking at, today we have a 14.42% total unemployment rate, and that's those who are on active unemployment collecting. It does not include all those people who've fallen off or have chosen not to work after all this time. So with that said, that was set to lay the ground so that we could look at this. Can you guys now see an Excel spreadsheet? Hello?
Yes.
You can
Yeah.
see, you can see it? Good. I stole this idea. This is not my original idea. I stole this idea. Give credit where credit is due. A guy named Jonathan Twombly. He's a multifamily syndicator. He's out of the New York City area. And he was on a podcast, One Rental at a Time, that I saw this on, and I thought it was worthwhile bringing to you folks. So I created my version of it and brought it here, but I want to give him credit for the idea and the approach. The idea here is we're looking at a 200 unit property in the Philadelphia area. We're going to use real Philadelphia numbers. The average rent in Philadelphia is $1,750 on average, and that's all inclusive from, small to large. It's an average. The average expense ratio for, this is a B plus, A minus kind of property. Average expense ratio is around 45%. Current cap rate in Philadelphia is 5.02%. So at these numbers, we're looking at $350,000 at 100% occupancy. And we're going to assume that for now, which gives you a gross income of $4.2 million per year for a property of this size. Currently in Philadelphia, I was surprised by this. I thought the number was lower, but the average vacancy rate in Philadelphia right now is at 6.8%. I would have guessed closer to 5. In fact, when I originally built this, I put 5 in there until I did the research and found that Philadelphia is at 6.8. So you take your 4.2 million, subtract out the vacancy of 285,600, and you got an average effective income of 3.9 million. Expenses at 45%, so you have your net operating income $2.152 million. If you're looking at, a lot of people will tell you when you take your going in cap rate and increase it by 0.5% for your exit cap rate. So I just use that rule of thumb here. That may or may not be true depending on your market. Could be higher, could be lower, but I needed something to work with. So based on a 5.5% cap rate, exit cap rate, value of the building is $39,144,000. Nice size building if you can get it here in Philadelphia. There's a lot of them for sale for 50, 60, 70,000 right now, but or million. But nice size building. Now, if you remember, we were talking about concessions though, and what's the impact of concessions? And we're going to assume in this case that concessions are rent reductions. You saw that chart I gave you, 4%. And then I did a 5%, 6%, 7% rent reduction. I also went with a 1 month here in red. You'll see this red section here. 1 month of concession is just over an 8% reduction in rent, monthly rent. 2 month concessions is almost 17% reduction in the monthly rent. And there's 3 and 4, but I'm not going to look at those numbers because frankly, I don't know that a lot of property managers are going to be willing to go that far, except for the one that I mentioned. So with that being said, if we look at changes in these numbers independently, you're not going to see that big of a reduction in overall value here. And this percentage here will tell you what the reduction is. So if I take that 1750 and I go to 1680, not a big rent reduction, only 4%, and I don't change anything else, you see a 4% reduction in rent. If I go to 1663, which is the 5% concession, you see a 5%. So on and on. You see a like kind reduction, 1604 for 8%. And you see a little over 8% reduction in value of the property. But we know that rent reduction, expense ratios, and vacancy rates all move together. So does the exit cap rate as a result. So if we go back to 1750, and let's just change the expense ratio to 50%, what does that do to our value change? You see a 9% value change just by having expenses creep up by 5%. Okay, go back here. If vacancy goes up 1%, which is not uncommon, you see only a 1% change in the reduction in value of the property. Put that back. And then if you look at cap rate, obviously if this goes up by 1%, 6.5, you see a big change here. You see a disproportionate change in the reduction in value of the property. So the basic thesis here is, if we're looking at, and let's just start with the 1 month and 2 month rents, because rent reductions, because that's what we're seeing. If we go to 1604 rent reduction, You're going to see expenses continue to creep up. I'm not going to take them up very much. We're not going to go above 50% in any of this example. We still have our going in cap rate. But the reason that you're giving concessions is because your vacancy is going up. So if our vacancy goes up to 7.5, which is what Freddie Mac was forecasting, you're also in a market situation where now your cap rate's going to increase. So let's go up another 0.5%. So let's go up to 6%. You're looking at almost a 25% reduction in the value of your property. And that's, small changes. Those are things we're seeing today based on what's happening in the market. If you go to the 2-month concession and not change the expense ratio, if you're in enough extremis to be looking to give 2 or more months of concessions, your vacancies probably have gone up to around the 8% rate, which from where we're at today is not very high. I would suggest it would probably be higher, but we'll be conservative at 8%. And your cap rate's probably going to change or decompress by a little bit. So now we're 1.5%, or we're only 1% above what we forecasted our exit to be. That takes you to almost 37% reduction in value of the property. Your $39 million property is now only worth $24.7 million. What this also means is, if you understand from a bank's perspective, okay, understand a bank can take over a property. They can kick out the syndicator. They can kick out any member of the GP. They can kick out the property manager if you're not meeting, if you're in technical default of the loan. Technical default of the loan means you don't have enough reserves. Your debt coverage ratio is not satisfactory if you're not paying the loan, obviously. If you're seeing a 36% reduction in value of the property, and I'm being conservative in some of these numbers here, if we went to 8.5, again, it goes higher. And if this goes by more than 1%, 6.5 to 7%, whoops, 7%. You're over 40% reduction in value of the property. Why is this a problem? Why is this important to know? A lot of syndicators in the last couple of years have been buying at 20 or 25% leverage on a property. And they have to sell in 3 to 5 years, which is coming up in either now or in the next couple of years. There's a very real risk that if this recession behaves in the same way that the last 2 recessions have behaved, that we're going to see these kind of vacancy rates. We're going to see these kind of concessions. We're going to see a decompression or a rise in the cap rate. And when they go to refi, they're going to be underwater to their existing loan and not be able to refi. They'll have to bring money, millions of dollars to the table in order to refi their properties. And if they can't refi, what are they going to do? They can try to sell outright, but no one's going to offer them, enough money to make this worthwhile. They're going to offer them, the 22 million, not anything close to where they need to be at $39 million or whatever that number was. So now they have to turn the keys over to the bank. All their friends and family and all those people they got to invest with them, all that money is gone. It's lost. So part of it is, if you're going, and I'm not saying this to stop you from buying now, what I'm suggesting is that when you're buying, you be conservative in your numbers. You factor in some of these what ifs and maybe do some kind of a what if drill on what different things can happen so that you're buying it at an appropriate number, or you're buying with the appropriate amount of leverage. If you're buying at 60% leverage, you can sustain a 40% hit and still be at, even keel. But with everyone buying at 20 to 25% leverage, if their property values go down, by 35 or 40%, they're screwed. They can't get out from underwater. And we're going to see, and now, will this happen to a lot of properties? Maybe not. It depends on how long of a term they have on their loans. Just to give an example, right now I'm looking at 10-year loans only because I know that the Fed has said they're going to start raising interest rates in 2023. And I know that this recessionary cycle will be over by then. So I'm hoping that we'll see more inflation, we'll see higher wages, we can maintain or increase rents. That gives us time to breathe. Whereas a lot of those syndicators who all their documents and all their business plan is, 3 to 5 year hold, increase rents, and then refi or sell, could be in a world of hurt. We've already seen that 2.8 or $12.8 billion is already behind and in forbearance. And that number could increase as a lot of these other loans come due in the next couple of years.
Now, Dennis, real quick, I understand from an investment strategy, only holding something for 3 to 5 years, refining, getting everybody their money back. But is there a term with the bank where their loan is due in 3 to 5 years? So essentially, what's to stop all these other syndicators from just saying, hey, we're going to hold on a little bit longer?
They'll have a balloon. The bank, it depends on how they structured their loan. A lot of times they'll take out a loan with a 5-year balloon.
So mainly the poor situation that they're going to be in is driven by the financing.
Yes.
Okay.
Yes. And that's important to understand, because when you're going to buy, financing is the biggest part of your capital stack here.
So
But just holding something for 3 years seems crazy. I mean, if you're buying something that's, let's say, undervalued, it may even take 1 to 2 years just to even get it stabilized, let alone get some equity in there. So that just seems from the beginning to be a little.
Well, but if you're doing a value add or a repositioning, you can achieve that increased value in 2 or 3 years. If you can, improve the property, raise the rents, put in good tenants in the first 2 years, and then show 1 year of operating successfully at that level, a bank's going to value that property at those higher rates. And so that's what a number of syndicators are counting on doing. They weren't counting on a pandemic hitting them and causing a bunch of issues that they couldn't foresee. Now, what this potentially means is that there's going to be I won't say an overwhelming percentage of properties are going to have this happen to them. Most of them are still going to be fine, but there's going to be a lot of properties that are going to be in this situation. They're going to be in technical default of the loan. The banks are going to start looking for buyers. All that money you hear about that's on the sidelines waiting to jump into good investments. That's when they're going to jump in, when there's a lot of blood in the street or blood in the water, whatever the proper term is. And they can see a property that was once trading for almost 40 million is now trading for 22 million. That's when they're going to jump and buy. So if you're looking to do syndications right now, if you're going to buy, you need to be careful of this in how you're approaching the buying and structuring your financing and all of that, and how much money you're going to raise. The other opportunity here, though, is get those investors that are sitting on the side into your contact list and keep them warm, so that when a good deal does pop up and when this time hits, that you're ready to go, that you've got the money behind you to go ahead and swoop in when the time comes. So to me, that's the bigger potential upside to all of this, is knowing this ahead of time, knowing there's going to be some issues. And if you're prepared to address those issues and to take advantage of them in the next couple of years, to do that, you need to have the money in your back pocket.
So Dennis, so when you're going out for these loans and like to the banks, and please correct me if I'm wrong, what I'm hearing you say, a lot of syndicators are only going in basically for like 3 to 5 years, or maybe 5 to 7. So a lot of these people are not going in from the door with, say, like a 20-year loan.
No. What they'll do is, now the banks won't let them, most of the banks, there are a few programs out there that will go 20 or 30 years, but most bank loans or financing, especially if they're backed by Freddie Mac or Fannie Mae, they'll amortize it over 25 or 30 years, but they'll put a 3, 5, 10, 7 or 10-year balloon on it. Because they don't want to give you, especially today, they don't want to give you a 2.5% loan for 20 years or 30 years when they know the interest is going to go up and they're going to lose all that ability to make all that more money. So they want you to refi the loan or have you refi that, have a chance. They want a second chance at increasing that interest rate if interest rates are up when that balloon comes due.
Okay, got it. Thank you.
And you have to remember, banks are in it to make money and take away as much money as possible off of you. They're not in it to help you. The banks are not your friends, no matter what they say. Remember that.
But they will smile a lot when they hand you a check for 20 million to buy a property.
Right. And then they'll figure out a way to get more fees out of you throughout the time that they have the loan.
Oh yeah. Oh yeah.
And they're good at that. And because they have bought off all of our leaders, they have bought them off, they can do that legally without any fear of repercussion.
Yeah, when you
Just
look at the
remember
loan,
that.
when you look at the loan documents that they give you after they approve your loan, there's 60, 70, 80 pages long. Believe me, there's a clause in there that says if you blow your nose wrong, they could probably repossess. But if you look hard enough, I bet you could find something like that.
Dennis, a couple of questions from a novice.
Sure.
When you get the expense here, is that all your expenses, including the mortgage payment?
Not the mortgage payment, no.
Okay.
This net operating income is before principal and interest payments.
Yeah, the expenses are just operating expenses. Mortgage is not an operating expense.
Taxes, insurance, repairs, maintenance, management fees, salaries, utility bills, advertising, legal fees to evict. I mean, all of that is part of the expenses, but not the mortgage payment.
And also, so when you were doing the calculation, you were changing the cap rate that you have in column D. Who set that cap rate?
There's no one person that sets a cap rate. A cap rate really is a reflection of an appetite for risk from investors. And let me give you an example. If you remember back on that one chart that I had, where is it here? Can you see the cap rate breakdown chart?
Yes.
Okay. These are the cap rates. So C class properties are considered higher risk. There's another class called D, which is in the war zones of a lot of cities. But the A class properties are the least riskiest. They're the newest ones. They have all the best amenities. They have coffee bars, they've got gyms, they've got saunas, movie theaters, they've got, pools galore, all kinds of stuff, barbecue places, and they charge $3,000 a month in rent. Class C properties is your standard 2-story property that might be out in Jenkintown somewhere or something, I'm not sure. And, but they don't, if they have a pool, you're lucky. If they have a leasing office, that's probably good, and they don't have a whole lot else. But those properties aren't able to make as much actual money as the A-class properties. So they're considered to be a higher risk. So therefore, people are looking to pay less money for them. People will pay more money for a newer property than they will an older property. And so it's a reflection of risk.
Yeah, well, the other reason that the reflection of risk is the fact that in the Class C properties, we're talking about the average working person. So the odds of them not being able to afford the rent is higher.
Correct.
As opposed to somebody in a Class A. And usually Class C properties do actually produce more cash flow. It's just you don't know whether it's going to happen every single month or not. And they don't appreciate as much as a Class A, which is what the other reason why Class A are more value. They do appreciate more and faster because of all the amenities, like Dennis said.
Yeah, it's really a reflection of, if I paid all cash for this property, what kind of a rate of return would I want to get to spend, 20 million on a property? If it's a Class C property, then I'm going to be looking for a 7% rate of return. If it's a Class A property, I might be willing to accept a 5% rate of return for the reasons that Raphael just said. So it's a reflection of risk. Basically, if I paid all cash, what kind of return would I reasonably expect to get? And that's up to individual investors too. There are people out there that are pay stupidly high prices because they've got nothing else better to do with their money, or they need to spend it for some reason. But then there are a lot of more prudent investors who try to be a little more careful about investing money. So, and that all blends into what these numbers are. So did I scare anyone from investing in multifamily yet?
I'm uber scared, but you know, I guess it depends on how you do it.
Well, there's no reason to be scared. Just only be wary and informed. That's really all you need to do. Because fear, what is it? Fear is false evidence appearing real. That's the one I learned. I mean, all fear does is stop you from making money. But if you're very wary and very careful, you can make money on this, whether it's a 6-unit or a 244 unit. It's not, don't let fear stop you. Just make sure that you're very careful. That's really, and I think Dennis brought that up several times, is the risk that you're taking. How much risk are you willing to take? So just follow that and you'll be fine. It's just, you gotta be aware of everything and just don't take, like Dennis has told me several times, don't be over positive, which I intend to be a little bit aggressive, and he keeps me down a little bit.